The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Good.
It's going to be another day, 100-degree day today, I think. Keeps going on.
Brutal. End of July, beginning of August is tough.
I thought the spring it would never stop raining, and now it's just searing everything to death.
Using it up.
I know. I can't leave my dogs outside for 5 minutes. They're kind of wimpy dogs anyway. They'll die if you leave them out there too long.
They're spoiled like the rest of ours.
Oh, yeah. Oh, my gosh. I was sitting there going, kids of today are different, but I think every parent has thought that generation upon generation, they're not like us. Because I'm thinking we're pampering our kids too much. My kids haven't gone through zero hardships. Zero.
Not if you were to talk to them, right?
Oh,
they think they have it hard.
I know. I'll try to explain to them. I grew up eating mayonnaise sandwiches for dinner. If you could find the bread.
Did you ever have
a mayonnaise sandwich?
Did you ever have like fried bologna back in school days and all that?
It was good stuff. That's meat.
I understand.
Yeah, there were times we had meat.
I mean, one slice of bologna and 2 slices of white bread, fried bologna, of course.
Yeah. No, it's a whole different world. We didn't have any, computers, didn't have anything like they have now. Phones and, you're just lucky to have a basketball that one of your buddies had that all of you could use.
Worn down leather. Hey, I saw a thought-provoking commercial. Thought it might be fun to discuss and talk about a little bit. We know about all the events, but when you hear them all put together, sometimes it really gets you to thinking. And what they were advertising ultimately for was to have you put your money in gold and silver. Obviously, it's good to have some. There is certainly risk there. It's not a safe haven as the commercial is portraying.
They say you want your money completely safe, put it in gold.
Put it in gold. Well, no doubt. But they went on and on. They listed, of course, earlier this week, Britain lowered their rates, right?
Yep.
Which, as we know, and evidence here in the United States, helps Wall Street. Main Street, not so much. China manipulating the markets. European countries, to an extent, manipulating the markets. Everybody seems to be printing money. But yet the markets are still going up. You're just climbing and climbing up.
Well, people don't have a choice, and we've had, 6 negative earnings quarters in a row. Last time it did this was end of 2007.
And what happened?
It crashed.
Yeah, what happened in 2008?
You got the PE ratios and other higher than they were then. So there's going to be one of those times where it's got to correct itself. Nothing ever goes up forever. It will.
I know if you're a first-time listener, you're thinking a lot of doomsday stuff, but if you're a long-time listener, you know that Victor and I aren't that way. We're very upbeat. We make plans for up markets and down markets so that they don't affect what we're doing in retirement. However, whenever they ask us, and we've had some questions on the air that, what do you think the market's going to do? Is it going to go up or is it going to go down? The joke is yes, because it'll do both. But the market's going to go down. It's just a matter of when, don't you think?
Yeah, it's got to.
Is it 18 months? Is it 8 months?
Well, I think we're 7 years now without a down year. I think there's never been an 8 or maybe one time in history.
It's a wrinkled up bull market.
Really, really getting a little scary numbers-wise. But there's no other choices. Think about it. 10-year treasuries are like 1.5% or something now.
Right.
10-year corporate bonds are like 2%. Well, dividends on S&P 500 are at 2%.
That's right.
And you're getting growth. With the other one, you can't get growth, right? So everything keeps pumping in. All those 401ks that did not exist 30 years ago have to buy every month. I mean, most of the part. Some people are putting in just in cash in a 401k. But for the most part, they're putting them in stocks.
That's right.
So what makes things go up are not earnings. It's more buyers than sellers. It's just earnings eventually catch up. In other words, the higher it goes up, the farther it goes down.
Well, and the point is, it's kind of kick the can, right? We keep kicking the can further and further down the road. sooner or later we're going to have to pay the bill. And I'm, again, not trying to be negative because we believe in the system. There's not a better country to live. I'm very happy to be here in America.
For all these
Free,
commercials.
but
put it all in gold. That's craziness.
Yep.
Don't put it all in gold. Put it all in real estate. Craziness again. You can't put it. You're putting something in something hot at the time, even though gold's not that hot at the time. But the commercials are real sexy. They're like, why did you want paper assets? You want hard assets, not paper. Paper's bad.
And they're tempting.
Hard assets are good. They go. What they'll say is, countries are hoarding them. Billionaires, they're hoarding gold more than ever before. Blah blah blah. But it's a bunch of horse crap.
I think they used Cuban because Cuban was actually on Squawk Box months ago, and he was getting into gold and buying and a proponent. Last week in the show, you started off talking a little bit about the show you heard on real estate and them telling them to quit their job and sell their 401k to invest in real estate because of the guaranteed returns. This week, I've talked to 4 or 5 people that are investing in real estate. I know the market's on fire. It's hot right now, but they must be running a lot of spots because there's a lot of people now turning to real estate.
Don't confuse what we're saying. There's nothing. We own real estate.
Absolutely.
There's nothing wrong with real estate. There's nothing wrong with the rental property. Nothing wrong with gold.
You've
or
got
silver.
rentals.
Yeah. You get all of those different things. There's nothing wrong with them. But you don't put your entire 401k. You don't sell your 401k, get a mortgage on your paid off house
right.
to buy rentals. That does not make any sense at all, except to the real estate salesman. And like I said, I talked about this last week. The worst advice I'd ever heard is a radio show, on, I think it was this station. I can't remember. I was driving back from the lake or whatever, but it's ridiculous. You're talking about, he told everybody cash out all their retirement accounts. Everybody comes to my 2-day seminar, cashes them all out within, 6 months or something.
It's not your money anyway.
That's right. Not your money. Pay the tax, get out of them. One lady told her to do that and get a mortgage on their house, and they're 55. And then she said, well, I'm only 55, so I can't get the 401k. Well, can you quit your job? That's the craziest advice I've ever heard. But people listen to it because they want to hear it. They're like, yeah, that's right. That makes a lot of sense. Right now, real estate's doing great. Okay? You can't ask for it. You just sold a house, right, guy?
Crazy.
Fantastic.
Crazy.
In Plano, which is probably the hottest market around, right?
Yep.
And but it will always overbuild when the demand's high, and they'll have a glut. It'll go down, and then the cycle repeats itself.
The show's called a Common Sense Investing Show for a reason. Common sense would tell you that real estate is good for a portion of your money.
That's right. Like I said, portion of your money's in stocks, portion of your money's in precious metals if you want, portion of your money's in bonds or CDs, portion in real estate. That's all sound advice. Not telling somebody to take a 40% hit. They told him it was like a 25 or 28% hit. You cash in $1 million IRA, trust me, it's 40%. It's a 40% hit.
That's right. Your income just went up $1 million that year.
Took you 30 years to save this money. You're going to lose half of it in one fell swoop.
Yep.
Because they said, well, you're going to make double your money every 18 months, 10, 15% a year. Come on.
Be real careful. If you're 50 plus, you're a real target because you've got a little time now. You've saved some money, and however they get the names and the leads, you're just targeted by everybody on the internet, everything.
Don't you remember, guy, when you turned 50? All of a sudden, the spigot turned on to my mailbox.
Oh, yeah, right.
Oh, my. First, it was AARP,
Seminars.
Oh, my gosh.
AARP is one of the biggest marketing groups, I think, on the planet.
They flood my mailbox. I get these, look like golden tickets. Here's your golden ticket to this seminar. Here's your magic thing. Oh. And sometimes I'll see them. It's the most beautiful thing. And then they have a picture of the person giving a seminar. He looks like he's 12.
I know.
I'm like, what is this?
We're getting old.
But I'm in that demographic. You look for somebody 50s or 60s that live in a certain zip code, make a certain income. I'm on every mailing list out there. So unless that mailing is coming from us, just throw it away.
That's the best advice I've heard you give in a long time.
We don't really send mailings, but I'm saying if we decide to, that is the mail you should keep.
That's right. And our philosophy, as always, has been to make sure your hard assets are taken care of. We, right now, because of the low interest rate environment, Victor went through the numbers on bonds right now and certainly CDs. Right now, fixed annuities do a great job of providing income, especially for your retirement accounts, which at 70.5 with your required minimum distributions are a forced income stream anyway. If you take care of those costs, the real estate investments, your gold and silver, if you get caught in something you shouldn't be caught in, it won't affect you.
I was talking to a neighbor of mine who's an engineer, and he was asking me what his plans were, and it was rental property, this and that. And he said, why do people like these annuities so much? I know you do them. And
Right.
I said, it's just the economic conditions we're in now. I said, remember that 3% rule used to be 4? You got $1 million, you can take out 30 grand a year. I said, well, the annuity you can take to get 30 grand a year might cost you 300,000 instead of $1 million. So it just allows you to take 1/3 of the money you normally would to produce the exact same income.
Big deal.
And to make it steady and predictable for the rest of your life. That's just what it is. I go, if bonds were paying 8 or 9%, I'd use those. You know, if I could get a CD at say 6, 7%, I'd use those. But we're in a different world now. They're not going to ever be up there probably again because of the debts.
And you've heard us talk about this over and over again. If you want a quote, we're happy just to give you a quote. Your age, your 401k amount, how many years before you need the money.
And the younger you are, the more it goes up. Don't hesitate to call us at 972-715-2424. Again, 972-715-2424. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Instead of some sales pitch. I like that.
Welcome back to the show. We were just talking about, we're about to go into your questions. Remember, we developed this show to answer your financial questions. We don't want to sound like, professional advisors because you can't understand half the stuff comes out of their mouth. So we do this plain spoken language as we can. But right before I just want to finish up, I was talking to my neighbor who happens to be an engineer.
Right.
Yeah, we get really into the geek talk because I've taken all the engineering courses, all the mechanical engineering. I said, but I've got electrical, nuclear, and everything else on top of it.
Still remember the periodic table and all that?
Well, that was the first thing I remember from the chemistry thing. When they pulled down that thing, I'm like, oh, man, I got to memorize all that. But we're talking about it. I said, hey, it's just math. He goes, well, I keep control of my money. I like the stocks. I do index investing. I go, that's good. That's smart because the really low fees, that's smart. And he goes, and I'm okay with the risk. I go, smart again.
And he's young enough, right?
Yeah, young. I said, well, there's nothing wrong with that. But remember, it comes down to math. Your $3 million will produce $90,000 a year. The annuity, $3 million will produce $300,000 a year. It's not as liquid as your other one, right? It's going to have some, but 300 is different than 90. And so for some people, I said, so why wouldn't you take a portion, guarantee that same 100? In other words, just take one of your million, guarantee yourself $100,000 a year till you die, plus Social Security, plus any pensions, and then the other $2 million can grow, can do whatever it wants. You never have to touch it. I go, so it allows you, instead of having to use your whole $3 million to fund your retirement, you're only using $1 million of it.
You got all sorts of options are wonderful, especially in retirement. You can take half of what you were planning, right? $1.5 million instead of $3 million. Give yourself a 50% raise or a little bit better, right? You've got 150 coming in instead of 90, and still have $1 million. So you've gotten a raise, you've protected half of the money, and you still have half.
And
of
you're
it.
guaranteed for the rest of your life, your money can never go. You can never go broke. That's important stuff. Plus, there's long-term care benefits on a lot of them. Long-term care is a real issue. If you've got under, say, $2 million, it could be a real issue.
That's right.
If you've got over $2 or $3 million, you can probably self-fund. Some people still buy insurance just in case, but you can probably self-fund. But that's what I'm saying is it's just I'm a math guy. It's just math to me. What I'm going to do is I'm going to take up, all right, here's the pros and the cons. And we do this for each investor. Here's the pros of this strategy. Here's the pros of this strategy. Here's the cons of this strategy. And let you weigh it out.
Here's how long your money will last with it. Here's how long it'll last without it. We've talked about it. If you didn't catch us just before we went to break, one thing we've been having a great success with, a lot of you aren't sure about annuities. Maybe you have some. If you want a free quote, if you want to see what yours is worth based on your age, your dollar amount, how many years before you're going to retire, the numbers are all different. You probably have no idea what it would pay you. Call us, give us your age, a dollar amount, and how many years you can defer it. In other words, before you need income, and we can tell you exactly
whether you have
get.
200,000 or 200 million. We'll give you that quote. Like I said, there's no cost, no obligation. Nobody's going to bug you. Our number's 972-715-2424. 2424. Again, 972-715-2424. You can always go to our website at ilovemyretirement.com. All right, guys, time for questions. Anytime we get questions from customers, from callers from our radio show, either in person, on the phone, or by email, and we find one that we think that appeals to a broader audience, we're going to share it with you. We don't put names and all that kind of stuff to make it dramatic. We want to protect the people that call. So anytime you have a question you'd like it answered, don't hesitate to call us at 972-715-2424. All right, Guy, what's our first question?
Our first question is, how much should I contribute to my 401k?
How much should you contribute to the 401k? The short answer is as much as you possibly can.
And the absolute minimum amount should be at least enough to get your employer's max.
Oh, yeah, that's your minimum. A lot of people think
Match.
that's their maximum to get their match.
Right.
No, that's your minimum.
Yes.
I've done the math on this so many times over the 30 years that we've been doing this, but people still don't get it sometimes. They're saying my company only does 6%, which is good, by the way, nowadays.
Oh, yeah.
And I say, so I'm only putting in 6. I was like, that's a guaranteed 100% return. That's it. He goes, that's right, cheap so-and-sos.
Free money.
I go, what if you put in 12%? Well, I told you, Victor, they only match 6. I go, that's still a 50% guaranteed return. 50.
Yeah.
And you wouldn't have kept all that money anyway. Think about this. You got $1,000 going in a month, whatever the number is. If you're in a 30% tax bracket, right, it means you only got $700. But you can put $1,000 directly out of your check, or $700 goes in your pocket because you got to pay tax on it. This is before tax. So you can pay that $300 to your own retirement plan, or you can pay it to Uncle Sam. What do you want to do? Of course, it makes sense. There's no way anybody tells you, I hear this advice as well. Remember I told you, anybody tells you to cash out your 401ks and buy real estate or something like that is nuts. They're not advisors. They're not fiduciaries like we are. They are one thing. They're salesmen.
That's
and
right.
they don't care if you go broke, as long as they get paid the commission. You should always put in the most. There's nothing in the world, even if your choices aren't that good, that will accumulate assets faster than a 401k.
Now,
Nothing.
we're not chastising you for not putting in 18,000 or 24 if you're over 50 with the catch-up provision. But our point is, if you can afford to do it, and you're not because you don't think it's a good place, and perhaps you're taking that money, paying taxes, and investing it elsewhere, we're just asking you to rethink it because you got more money growing for you. You're saving on taxes. If you can put more in and you're not, you should. Obviously, if you've got kids in the school and everything's maxed out and you're doing what you can do, that's fine.
This is a litmus test when you're talking to advisors or so-called advisors. As soon as they tell you, don't put money in a 401k, only do the match and put the rest in with me at this investment program, it automatically is a bad financial advisor.
Red
They're just
flag.
a salesman trying to sell you something. Stay with us, folks. Remember, if you have any questions, call us at 972-715-2424. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. I want to repeat one thing we had before the break. Nothing can accumulate assets better than a 401k. Don't get me wrong. If you got in some investment that made 100% a year, obviously it would. I'm talking about on a normal situation, normal case, since it's tax deductible and deferred and a possible match, it accumulates assets faster than other investments. They have to pay tax and then invest and then pay taxes along the way. It's almost impossible to beat a 401k. So anybody that tells you to invest in something other than that first, now they're suspect because now they've turned themselves into investment salesman instead of advisor. And it's easy to tell. They go, well, all you got to do is sometimes you can set a trap for a potential advisor. Just say, well, I don't know. My company doesn't have that great of a 401k. What about not doing that and investing in your program? See what they say.
Nothing better than knowing the answer to a question before you ask it, correct? When you're interviewing somebody?
As soon as they tell you to get a mortgage on your paid-off house and sell all your 401k.
Because their deal's so good.
That's right. And you can't get out of your 401k because you're only 55. Can you quit your job?
That's right.
That's red flags and hammers hitting you on the head. Get away. This person's a crook.
Run.
I know. All right. What's our next question?
I just got a new job, and I have multiple options with my 401k. Should I transfer it to the new job's 401k? What are your thoughts?
You can do that. One of the keys to transferring it to the new company is to make sure the newer one, the fees and the choices are commensurate with what you're already paying or better.
Absolutely.
If they're worse, you might want to do an IRA. Remember, if you're 35 years old, you got a long way to retirement potentially. And so 401ks sometimes with bigger companies have such low fees. You know, I've looked in depth at some of the big companies around here like TI and all that. They have some really good 401k choices. I'm talking about fees of 0.006, just really, really cheap stuff.
Crazy low.
So those are pretty good if you're willing to take the risk of the market. We're usually working with somebody a little bit down the line, 50 plus, that really is trying to set up for retirement. So then transferring into a self-directed IRA opens up your choices. You can still buy low-fee stuff in an IRA, but you can buy all the other investment products. I mean, it's almost unlimited, the products. So that's why rolling it over makes the most sense for a vast majority of people. But for some people, putting in another 401k with a large company is not a bad idea. The only mistake I've seen is they'll go into the 401k with a small company, and they're paying like 5 times the fees.
And hidden fees.
Yeah.
The warning on this, or the caveat I would add, is obviously if your 401k is substantial before you go to the new job, moving it to an IRA, as Victor pointed out, gives you a lot more choices. You're not limited to a small amount, but it also exposes you to all of these guys that want to have a piece of it and want you to invest it with them, and they'll tell you whether it's gold and silver or real estate or viaticals or life settlements or whatever the deal of oil and gas even can accept them if they have the right custodian.
It's always the hot topic of the day. Remember, it was life settlements, it's oil and gas, all the way till they crash.
There's custodians.
Now it's rental properties, right?
There's custodians out there that will hold your money and let you invest into commodities, which is one of the riskiest things on the planet. So just because you can put your IRA in these other investments doesn't mean it's IRA approved or IRA safe.
Every time I hear that, we're IRA approved, IRS approved. Are you kidding me?
Be careful. If you move it to an IRA, you still want to use common sense.
That's right. All right, what's our next question?
I don't know. Let me look. All right. Famous investor Jeff Gunlock is saying that the market is going down and to get into cash. So is famous banking giant Goldman Sachs. Where do you put your money now?
Well, if you have a really good plan in place, it's okay to stay in the market.
Follow the plan.
There's nothing wrong with the market if you have a plan in place. Now, with that being said, after 7 up years in a row and 6 negative earnings quarters in a row, I'm not in a buy and hold kind of frame of mind right now. I have to have a program with an exit strategy.
Now it would be buy and hope.
Yeah. Yeah, I'm much more of a exit strategy kind of guy now. So no matter what, there's a mechanical system in place for like our managed accounts. They're in every sector of the market. The S&P 500 has 10 sectors, by the way, but 2 of the sectors are combined into one ETF. So you might have 9 ETFs, but also have, alternative ETFs and fixed income ETFs. And they're in all of those sectors until the market turns or goes below its moving average. Any sector goes below its moving average, it's automatically out of that sector. And so it's got an exit strategy. I don't want to have to call someone as an advisor.
Right.
Market goes down 50%, like it has twice in the last 15 years, and they say, well, what are we going to do? Stay the course? You don't realize the loss until you actually sell, so don't take those losses. Don't lock them in.
And you're retiring in 5 years?
Yeah.
No.
Oh, now you got to hope and pray.
That's right.
I'm not built that way. I can't take 50% losses at my age. I don't want to. And so I like the stock market, but I've got to have a hedge in there. I've got to have some exit strategy on my money. Now, with that being said, does that mean I don't like buy and hold? No. After a correction, buy and hold is fantastic.
Absolutely.
Oh, we got a break coming up. But remember, if you have any financial questions, like to take advantage of our retirement stress test, written retirement plan,
a quote,
or any kind of quote, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. The question before the break was, where do you put your money now? I said stocks are fine. You just got to make sure, in my opinion, that you have an exit strategy now. After a market tops out like this, if you look at it, they keep saying it's making new highs. It's like 1% more than it made 18 months ago. It's kind of just stuck here at the top.
And we've also talked about having a plan and how important it is, like a roadmap getting from New York to California. If you're planned out, you get there in 5 days, 6 days by car. If not, it may take 6 months. So you follow the plan, because if you have the right plan, it should adjust it as your age goes. You should be having less in the market, more secured. If you're younger, you can fade it. So if you have a plan, follow it. If you don't, as always, please get one. We certainly can help you.
And on the
with
product list, you can go to just a fat CD type annuity or something, 3%, buy a CD, 5-year, 1%. There's places you can put your money. They're just not paying a whole lot right now.
And if you're thinking of getting out of the market right now because it's been such a long bull run and because there isn't any real earnings for 18 months and because of the money being printed, whatever your rationalization is, if you're nervous, if you're uncomfortable, if you're losing sleep and you're really thinking about getting out of the market, just be careful, do it safely, and be wise about your decisions.
Now, think about this. A lot of people they're real popular, the index annuities now, but think about you're locking in. Let's say you got out of a piece of the market. You're locking in 7-year highs, right? You got a guaranteed growth 6-7%. Let's say you're going to retire in 10 years. So 6-7% for the next 10 years. It locks in your gains as you go. You get up years of stock market indexes, no down years. And you get a pension income that's 3 times, 4 times higher than you could get with anything else. So that's why a lot of people are doing that now. It's a perfect time to lock in the profits you've got, but now lock in a guaranteed result later.
Don't worry about getting the absolute top of the market, because if you're waiting, I don't want to get out until I get it all, ultimately you'll end up losing more.
I've never met a person that gets out at the top and gets back in at the bottom.
It's always the opposite. Why is that?
Well, because it's human nature.
I know, but it's
I'm not getting out of something that's making good money. Are you crazy? You may put in that 1% CD when I just made 15% over here? Are you nuts?
It's only gone down 5%. It's going to come back.
That's right.
Oh.
And then it just starts diving.
Yeah.
Nothing you can do. Once it starts, you can't do anything. You're kind of locked in. Then you'll freeze up. But remember, if you have any questions about investments, you want a free quote, you'd like to take advantage of our, retirement analyzer, which does a stress test. It does a written retirement plan. It does so many things. Tells you when your Social Security,
Great
when
program.
to take a Social Security, what inflation does to your investments. Are you going to run out of money with your current strategy? How can we optimize that strategy to make sure you never do? All of that is no cost, no obligation. Our number is 972-715-2424. Again, 972-715-2424. Or you can go to ilovemyretirement.com. All right, what's our next question?
All right. I think you had a couple instances of this, I believe. My company stock has always done really well. Since I know my company is a really good investment, should I put my 401k into the company stock? All of it, I'm assuming.
It's kind of a trick question. All of your money? No. Don't ever do that.
Right.
If my brother owned the company and I've known all the inside information, I still would put the kind of the rule like 10%. That's if you know them really well. If you don't, 5% or more, and that's it in the individual company. Because I know, the one story that I like is when I used to do a lot of stocks, just individual stocks. Remember that back in the old days, they called us stockbrokers.
Remember when you had to actually write tickets?
Oh, yeah. They didn't call us financial advisors. They called us stockbrokers.
Stockbrokers, that's right.
So we were doing this one company, and they invented caller ID. And they were telling me about it. They said, hey, before the guy picks up the phone, it's going to tell him who's on the other line. I go, get out of here.
That's crazy.
I go, it tells the name and their phone number. I go, no way, before they pick it up. It's a little box, a little white box you put to your phone.
I remember.
He goes, and AT&T, all of these big, I think it was the Bell companies back then, all of them are paying royalties for this technology. The company is called Colonial Data Technologies. That's because Wayne never heard it. They invented caller ID, and they had a patent. Everybody had to pay them until the big boys figured out a way around their patent.
Yeah.
Now they're out of business. But I thought that has to be a winner. I put a lot of money in that company. Then they had another company, remember the 80s, 90s, an AIDS cure. I don't care how great your company is. If you're talking about smart investing, and that's what we're trying to talk about here, you can have a large portion in one individual stock, and especially your company stock, because you're too vested there. Because what you've got is not only is your job relying, your retirement, everything in the world is based on one company doing well. And it might do great.
There's too many things that can go wrong.
Oh,
Bad management could be a great idea. Could it be bad managed?
I have some people come to me and they say it doubles, triples every single year and has forever, and I'll put on. And that might be the case. But when you're talking about being a prudent investor, take some off the table. If it's doing that, take some off the table every year if it does it.
And
because the one time you might have triple your money, quadruple your money when it does go down.
And if you're rebalancing your portfolio back into don't putting all your money into anything, you'll automatically be doing it, because if it's doubling and tripling in a couple of years, it's going to be too big of a percentage of your portfolio, so you have to sell
It's
some.
kind of like playing blackjack or something.
and
You keep
rebalance.
winning, just take some back off the side, keep
Yep.
it rolling, keep back. All of a sudden, you got 10 times what you put in. It doesn't matter if you lose that pile.
Isn't that bad etiquette if you're playing poker?
Yeah, don't care.
Don't care.
There's bad etiquette and there's smart money.
That's
right.
right.
Yeah, like I said, that's why I always like engineers and doctors, especially plotters. Most advisors can't stand them, and I don't mean to say anything to you engineers out there. They can't stand them
They get
because they dig
frustrated.
so far deep into a prospectus, and they're not prepared for it. Most of the advisors out there are really just salesmen, and they're good talkers. But when you go deep, an engineer is going to find out real fast if this particular advisor is packing the gear or not.
That's right.
And that's why we love them, because we've read through all the prospectuses, read through all of the possible negative things, negative press, positive press, everything. So we have answers for you people that really dig in.
And we know what each column means.
That's right.
Where the numbers are.
Right. Our number is 972-715-2424. Don't forget, call us for a quote, stress test, Social Security Optimizer, 972-715-2424. Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember our philosophy here at Dillon Gage. Our philosophy is, once you get to the finish line, you've saved enough money, and you can do a retirement plan that covers all of your expenses for the rest of your life. That's what you do first. And then the stock market is a great add-on tool. That stock market can help cover inflation because, long term, nothing's beat inflation better than the market. And also, you still got to have your reserve accounts and all that. But the number one thing I want to do, remember, we had a question last week. What would I tell a lottery winner? I would tell a lottery winner the same thing I would tell a pre-retiree. Why don't you get an income stream until you die? Cover that. In case you get stupid, in case you want to go buy, a Rembrandt, let's go ahead and make sure you get $1 million or $2 million a year till you die. Now, have at it.
The two things that you go hand in glove and that you need to take care of, in our opinion, certainly mine first. One, liquidity. We talk about it. Very important part of planning. It's expensive, we always say, because you don't make anything on that money. You might not want to put it there. You could do better and some other things. You got to have it. So get that taken care of. And then, as Victor just pointed out, get the income handled. Whatever it is you need, maybe plus just a tad, so you've got a buffer.
Yep.
Or unless you use some things now that provide increasing income, which are awesome. And then you can do your
think
other
about
stuff.
it. You'd give that same advice to any lottery winner, too.
Yep.
Anybody would. Get an income stream. I go, so if I'm about to retire and I've accumulated this amount of money, why wouldn't you do the same thing, advice you'd give someone else? All right, get an income stream with a piece. Make sure that covers everything till you die so that you can't go crazy. The market won't dictate your retirement. The economy won't. Nothing happens over in Europe, Brexit, whatever. Yeah, of course you do that. And that's why it makes sense to do it individually, a lottery winner. Even I have very wealthy people that say, I just want about this much coming into my bank account in case something happens to me. My wife just gets a check every month. This just covers it. And I got a trust to handle a lot of the other stuff. I just don't have to worry about bills or anything else if something happens to me.
The problem is, much like political press, where one side gets a lot of press, good press, the other not so much. It's the same thing with investments. We've had articles that we've offered up, important, from PhDs from Harvard and Yale, and they just don't get the press, but they write about doing the same thing. That's collectively how we come up with our philosophy. We read and we study and we ferret out the different things, and then, of course, we come up with a philosophy which works real well for us and our clients. But the point being, the smart guys out there are telling you that's what you should do, but you don't read about it that much because they don't get the press. Yet you have some billionaires that manage money, and they tell you, oh, you don't want to do that. You pay too much in fees or commission, which is not true. and they want you to have managed money and do different things in the stock market.
Nothing wrong with the stock market.
No.
You just can't. It wasn't never designed to pay your bills, not your monthly bills.
And that certainly doesn't give you a right to not guaranteed safe investments.
That's right. All right, we got time for one more question, I think.
It's a long question.
Oh, never mind. What?
You want to do it another time?
Go ahead. We'll try.
And I thought it was a pretty aggressive question, if I may say so. It says, how do you provide value as a retirement advisor? Great question, right?
Yeah, it might have been too late.
That's like an hour-long subject.
Well, there's a bunch of ways. People always ask me, can I manage my own money? Yeah, of course you can. You've got the aptitude towards it, whatever. Of course you can. You got the patience. You're okay with the risk. There's nothing wrong with managing your own money. The value that we get is, a lot of it is somebody to go with you, somebody to have a sound plan, all your ideas you can bounce across. Like when you should take Social Security. Is there a possibility my money will run out if my market or my portfolio only makes 2% a year? What does inflation do to my portfolio over time? I'm talking about modest inflation. We help you have a cohesive plan that all works together. Because what you do is you do a Social Security maximization. You got an income plan to cover your expenses. Then you got a long-term retirement plan to cover future inflation. Let's say you want to leave a lot to your heirs. All of those different issues can be covered. Yes, you can do it yourself, but having someone keep you on track, and also every few years you got to change all this because something changes in your life. Having somebody that has records of that, is somebody that your spouse can talk to if something happens to you, because typically, it's one person or the other really does the finances in a family.
A real brief scenario. We're kind of the coach of the football team. You're the owner. The players on a football team, that might be your finances. So we can get those together. We can give them strategies. We take the emotion out of it for you. You've heard us talk about a lot of times, emotion's a killer. It's the biggest reason that people get out at the bottom and get in at the top.
That's right.
You're emotionally, I'm scared, you get out. Well, that was the bottom. Now it comes up and vice versa. So if you can, look at us as coaches. You're the owner of the football team, and we're the coach, and the players are your financial pieces.
Controlling that emotion is probably the number one thing.
Absolutely.
It's called behavioral finance. And if you can control that, which is hard to do, especially if I tell people all the time, there's two parts of your retirement.
There's my life savings.
That's right. There's a financial part, but there's an emotional part too. And I'm telling you, if you're 100% stocks and that market crashes 50% after your paycheck doesn't come in anymore, it will cripple you. You'll automatically pull out of the market completely, put it in money markets, and you relegated yourself to a slow death until you die because you had too much in the market. If you had a plan in place, you could have withstood any of those market ups and downs, because no matter what, your bills are paid, and you can't foresee a time where they won't be. That is really important. And remember, we could put these plans together for you, but we can show you how they work at no cost, no obligation, and it really opens your eyes. If you're into, hey, I'd like to see what my life looks like at 60, 70, 80. I'd like to see what my bills look like at 60, 70, and 80, just with 2% inflation. We'd be more than happy to take care of that for you. Our number is 972-715-2424. Again, 972-715-2424. You can always go to our website. There's some great videos on there. ilovemyretirement.com. And like I said, don't hesitate to call us if you have any questions, you'd like a quote, or anything else. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure, and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice